Welcome, everybody, to Tokens of Wisdom. I'm your host, Dave Rothschild, a partner at Cole, Freeman & Mallon, a boutique law firm based in San Francisco with one of the leading private fund practices on the West Coast. Now, before we dive into today's episode, please listen to the disclaimer at the end of the show. Nothing said here by myself or my distinguished guests constitutes legal, investment, or tax advice. The guests that join us on this show are sharing their considerable wisdom, but everything they say is their own personal opinion and for educational purposes only. On this show, they're speaking for themselves and not for their employers or any other affiliated entity. Okay, boring stuff out of the way, let's get to it. All right, today I am welcoming into the Tokens of Wisdom studio Mr. Salman Ali, a managing director of CBIZ. And Salman is going to tell us all about auditing funds. All right. Salman, welcome to the show.
Thank you, Dave. I appreciate you having me on. I hear this is the coolest new podcast in our industry, so I'm happy to be on.
It's the coolest new podcast in any industry.
Absolutely. I stand corrected.
Well, why don't you tell everybody listening and watching us a little bit about who you are, who's CBIZ, what do you do?
I'm Salman Ali. I'm a managing director with CBIZ Inc. and a shareholder with CBIZ CPAs. I'm based here in Los Angeles. As CBIZ, we are currently one of the largest financial services firms in the country, unique in a few different ways, offering a wide range of services in accounting, tax, advisory, insurance, employee benefits, and HR solutions. We're operating in 22 major markets, coast to coast. I am a part of the CBIZ Alternative Investments Group, and we have deep expertise in all of the major verticals: private equity, venture capital, hedge funds, real estate, and of course, digital assets. We work with many digital asset funds pursuing a variety of liquid and illiquid strategies. Personally, I've been working with clients in the alternative investment space since the beginning of my career with a Big Four firm many years ago. I spent a decade with another national firm, including a few years in the Cayman Islands. I'm going into my 5th year in my current leadership role with CBIZ, and I'm looking forward to our conversation today.
Awesome. Thank you for that background.
Of course.
So I wanted to have you on the show today to explain to all of the Tokens of Wisdom listeners what is entailed in the fund auditing process. Now, like most people who are not accountants, as a lawyer, I hear the word audit and I get nervous because I don't really know what an auditor does. So let's start real basic. What does the fund audit process entail? What does the auditor actually do?
So let's start by defining the scope of our engagement. So the audit we will be discussing here is an audit of financial statements prepared under generally accepted accounting principles, commonly referred to as GAAP, under the auditing standards generally referred to as GAS, which is generally accepted auditing standards. So the financial statements we're discussing are prepared under ASC 946 of the US GAAP, which defines investment companies and disclosure requirements of investment companies, including both open and closed-ended funds. So 946 defines an investment company as an entity that does two things primarily. It obtains funds from one or more investors to provide investment management services, and only substantive activity of the entity is to invest the funds to obtain return from capital appreciation, investment income, or both. The funds or its affiliates do not obtain returns or benefits which are not normally attributable to ownership interest. So a typical characteristics of an investment company would include more than one investment, more than one investor. Investors are not related parties. Ownership interests in the form of equity or partnership interests. So we see a lot of limited partnerships in our world for that reason.
Of course.
And substantially all of its investments are managed on a fair value basis. So now we have established the scope of our audit and the applicable GAAP.
So that definition of an investment company will determine how the fund has to prepare its financial statements, and that's what you're then putting a microscope to and auditing. Am I right about that, or am I wrong?
That is precisely correct. Yes. So if you meet that definition, then you fall into the ASC 946 world, which basically is the world that you and I live in. But if for whatever reason your entity is structured or operating in a way that it does not meet the definition, then the general GAAP applies. You're not a 946 fund. You could still be doing things that are somewhat analogous, but you're not exactly an investment company as per GAAP. So general GAAP applies, and a lot of exemptions and a lot of exceptions that are available to an investment company under 946 would then not be available to you.
Okay, so someone who's not an investment company could still be audited. It would just be you'd be looking for different things. There are different standards that apply to the financial statements of those businesses from an investment company.
That is correct. Yes, your financial statements would look different, and that the process would be a pretty different process. But we audit operating companies all the time, so
Okay,
that wouldn't be a challenge to us. It would just be a different type of audit.
got it.
So coming back to where I was going was basically once we define the scope and the type of entity we're looking at, the goal of our audit is to issue an opinion on the financial statements, that the financial statements present fairly in all material respects the financial position of the fund and the results of its operations for a given period. So as part of our engagement, we perform audit procedures designed to gain sufficient appropriate audit evidence around relevant financial statements assertions to support our audit opinion. And in that part there, I baked in a lot of different pieces. So that includes the concept of materiality, which is a whole different concept. We can spend a lot of time talking about it. I included financial statement assertions, which includes a whole different conversation that we can go into. And then, what is considered sufficient appropriate audit evidence. That's, again, a whole different topic that we can go pretty deep into, but that's kind of high level of, what we do.
So basically, I guess let's touch on each of those really, really like high level quickly.
Sure.
Materiality, I'm assuming, okay, you're looking at something if you've got a $2 charge for, your Diet Coke at the corner store, that's probably not material to the financial statements. Maybe you don't have to go to the corner store and verify that the specific can of Diet Coke was actually sold to me at that time. That's not material?
In essence, yes. So the concept of materiality, for auditing purposes is basically at the financial statement level. So any piece of information that could result in a user making a decision that would be different than, that information being available makes that piece of information material. And that,
Okay.
that's obviously based on both qualitative and quantitative aspects, but the quantitative aspect is the easiest to understand. So yes, the dollar value example that you just described is a perfect way to explain that.
So you said materiality, and then there was something else I missed, and then there was audit evidence.
Yes. So financial statement assertions, I think we're getting
Yes.
into next as we talk about, the investments, but the sufficient, I talked about the audit evidence being, sufficient and appropriate to support the opinion, which basically literally is, those words. The audit opinion has to be supported by evidence that is sufficient enough to cover the materiality of that assertion, and the evidence has to be of a quality that can be used to support the opinion.
So I hear all the time people talking about different levels of assets, level 1 assets, level 2 assets, level 3 assets. What does that mean, and how does it impact what we're talking about here with respect to the audit?
In almost all the fund audits, that the most material item tends to be the investments held by the fund, which we need to get comfortable with, both on the valuation and existence of those investments. So when we're talking about valuation assertion, we're focusing on the assets and liabilities being reflected at appropriate values in accordance with applicable GAAP. So for funds or investment companies, this refers to investments being carried at fair value in accordance with ASC 820 as of the balance sheet date. So how we get comfortable with the valuation of investment depends on the nature of those investments. So this would be a good point to sort of, bake in the definition of the levels that we wanted to start with. So under ASC 820, the levels are primarily the levels of inputs that are most important to determine the value of that asset as of the balance sheet date. So for example, a level 1 input would be a quoted unadjusted price of identical asset or liability from an active market. A simple example of a level 1 security would be a stock traded in an active exchange.
Yeah.
A level 2 input is basically our inputs, either directly or indirectly observable. So a simple example of a level two security would be a derivative valued using the quoted market price of an underlying asset. So while say the derivative is not the traded instrument, the underlying asset is, but the input that is being used to determine the value of that derivative, that's observable. So that sort of falls into the level two bucket. And then the level three inputs are just unobservable inputs completely. So a simple example of a level three security would be an equity investment in a private company valued using market approach, where none of the inputs are observable. It's based on a model which takes some inputs which are factual, some estimates, some assumptions, which is resulting in a fair value. So that would be considered a level three security.
So level one, level two, and level three are talking about, I guess if I were to put it into my words, it's almost like the readily observability of the market value of the asset. So level one, it's super readily observable. You could take a share of Apple and see what it sells for on an open market. You can value that very easily. That's level one. Level two, it's one step removed. It's a derivative asset. So you're trading the derivative contract. It's talking about you're basing it on the price of an underlying asset that has a readily observable market value. But the derivative contract itself is one step removed. And then level three is there is no readily observable market value that you can just pick up and run with.
To simplify it even further, level one, is the easiest. Level three is the hardest. So,
Nice.
that's the flow.
Love it. Okay, great. And so, I mean, I'm assuming that then from that description, level one funds investing in level one assets are the easiest to audit, and funds investing in level three assets are the hardest to audit. Is that fair?
That's I think that's accurate. Yes. So
Okay.
in terms of not all level three instruments are created equal. I'm pretty sure you've seen that too. So yes, but in general, as a rule of thumb, I think I'd go with that.
Okay. And so, do you want to talk through, what is involved in the audit process, high level for a level one fund, let's say? Like you have to verify, I think you, if I'm remembering my audit school correctly, you have to verify the existence of the assets, and then you have to determine that they were valued properly.
Yeah.
Is that right?
Yeah, for sure. So let's talk about what would that entail. So we're basically, when you're focusing on the investments, you want to get comfortable with the valuation, and you want to get comfortable with the existence. So on the valuation side of things, depending on what sort of asset we're talking about for a level one security, it's a relatively easy process where you're using an independent source to verify whatever value the client has used to price their asset.
Yep.
So in general, as part of the audit, you would use independent sources to verify the inputs used by the client and test the reasonableness of the assumptions made by the management. So level one, there's not a lot of assumptions in the mix. There's no real estimate in the mix. It's an observable price that is available to anyone who wants to look. You're able to verify that quite comfortably. On the other side of that spectrum, which is the level three instrument, you have to basically understand how the client prices their asset, which is, are they using the right kind of model applicable to this type of an asset? And then once you get comfortable with, the model being appropriate, then you have to get comfortable with what sort of inputs are being deployed. Are those inputs factually correct? And then, the last part would be, are the estimates or the assumptions that are being deployed by the client, are they reasonable? So as you work through that process, there are several steps, and each one of them has the potential to kind of leading you down a different path. So a pretty simple change in assumptions or a simple change in inputs could potentially result in a material difference between what the client is coming up with and what the appropriate number might be. So we work through each of those steps. The key is we don't determine the fair value, we audit the fair value. So we're not coming at it from a position where we say, Dave, we know this better than you do. We don't. Our primary base position is that these are your assets. You understand them better. We will walk through this valuation process with you in line with what GAAP requires to see if we all end up in the same spot or not. And in most cases, we do.
So you're auditing the process that management underwent when valuing these assets more so than the actual ultimate value that they came up with.
It's both. I'm spending a lot of time understanding the process to ensure that there is nothing in the process that would, just inherently break the the
Yeah.
the system. But we also verify the inputs and get comfortable with the output to ensure that it's materially in line with what you would expect it to be. So it's a pretty detailed process which covers both ends of it.
So talk me through, I mean, for level one, it sounds relatively simple. Level
Yeah.
two, I assume there's a lot of shades of gray. Let's talk, I think the example you gave of a level three asset is stock issued by a private company. There's
Yeah.
no public market for it.
Mhm.
What what do you do to figure out if the assumptions they made were reasonable, the process they undertook to value it is reasonable? How would you do that for that kind of instrument?
So I think when you think about a private company stock, you potentially have two options there. One is you could either take a market approach, which is, find a group of public companies that are somewhat, comparable. And when I say somewhat comparable, because private companies are not exactly comparable to public companies ever. There are a number of factors that you have to take into account. So, say for example, we start with they're somewhat similarly positioned in an industry. They're not
Hmm.
completely different. So, the common example that I always use in these situations is if you launch, let's say, a company that manages a search engine today. Would you compare that to Google tomorrow? You wouldn't. There's a significant scale that would need to happen before we get to that point. So the step one is you want to identify a group of companies that are comparable.
Hmm.
There would still probably be a discount that would need to be introduced for lack of marketability. But again, a whole different topic. We can go pretty deep in that too. But let's say we find a group of companies that are comparable. The next step would be, what would be a good metric that can be used in this situation. So in majority of the cases, we see revenue multiples being used, and in a large number of cases, we see EBITDA being used. But you want to develop a model that produces consistently a fair value estimate for that kind of a company in that kind of an industry. So that could be like a very simplified market-based approach that leads you to a fair value estimate. Another way of doing that would be, using the income approach, which is, and all of these are, described and defined within guidance. So, uh,
Hmm.
you know, in an income-based approach, you would have an estimate of the cash flows of the business, and you would apply some sort of a discounted cash flow. The challenge with that is obviously, forecasting cash flows of a growing business is not always easy. And depending on, who's putting the forecast together, there are sometimes more aspirational than they're realistic. So, auditing any kind of forecast is never easy. Auditing a cash flow forecast is always challenging. And the assumptions around what sort of discount rate would make sense, are complicated. We get comfortable with them. There are ways of doing it, but those would be, two pretty basic examples of how you would sort of test a value of that sort. And by testing, I mean, those would hopefully be models that are prepared by either an expert hired by the client or an in-house expert who knows these investments, inside and out, and you can put together a model that's pretty robust.
So by the time, let's say I'm a manager investing in level three assets like these private companies, and I mean, by the time I get to you and the audit process, I mean, I've been making these investments, right? And I've prepared my financial statements already. I guess I've made these assumptions already. Now, I think you mentioned there's the market standard, the market approach, and the income approach. Let's say I chose the market approach. When you come in to do the audit, is that you open up the books and say, okay, it looks like you chose the market approach. I probably would have chosen the income approach. So you're wrong, your audit is blown already? Or is it you chose one of the two, commonly used methods? Now I'm going to analyze the method you chose by the way you did it, even though I probably would have done it differently. Is the I guess which one of those?
So it's never the case of I would have done it differently. That's not the goal. That's
Okay.
so I would start with, the if you're using either of the approach that are prescribed and are allowed by the standards, you're not wrong. You're
Okay.
perfectly fine. The key is, when you're going through that process, what I would expect you to do, and this kind of is sort of a slightly different answer than probably what you were hoping for, but as you're setting this up, I would expect you to spend enough time knowing what the requirements are. So you set it up correctly. So, that avoids a lot of problems down the line. But having said that, let's assume that you picked either of those models. In my experience, it's usually not the model. It's usually the inputs that can create more issues. So if you choose the right model, but your inputs are incorrect, or for whatever reason, your assumptions are not reasonable, that's more likely to result in an adjustment than just choosing an incorrect model, which can happen. It doesn't happen very often because most of our clients that we work with are sophisticated investors. They understand the investments better than most people. So they know exactly which models are applicable, which make more sense than others. So we typically don't run into model issues. We're more likely to see, I would say, potential adjustments emerging from input issues.
Okay. Okay. Well, that makes a lot of sense. And so level 1, level 2, level 3, valuation issues. So let's move on to verifying existence, because that's something the auditor has to do also, right? You have to make sure that the assets listed in the financial statements are actually assets that exist and that the fund owns, right?
Yeah. So now we're basically going into the next assertion that we had mentioned initially, valuation and existence. And now we're talking about existence. So existence as a concept is as self-explanatory as it gets in our world, referring to the assets and liabilities of the fund existing as of the balance sheet date. So to gain comfort over existence, we develop a deep understanding of the custody arrangements made by the client. In some cases, a third party qualified custodian can provide evidence over existence. In many other cases, we may need to confirm directly with investees. So let's break that down into a couple of quick examples. So say, for example, you're a fund that invests in nothing but level 1 securities. Everything you do goes through a prime broker that custodies all of your assets. So as the prime broker in that position, and let's for now work with the assumption that they're a qualified custodian, we can obtain a confirmation directly from the third party. And that could provide sufficient evidence to cover existence for that type of a security. In another kind of a world, say a digital asset fund, where your assets could be in a few different types of custody arrangement, where you could have something in self-custody, you could have something with a third party that's not a qualified custodian, you could have some assets in an exchange in a different country, and you could have some assets with a third party in a segregated wallet. Each of those would require a different kind of process to get comfortable with the existence. And we go pretty deep in that stuff. So, with self-custody, we have a group of specialists that would go pretty deep into, getting access to all of the assets, obtaining all of the activity, and testing out all of the transactions to ensure that everything adds up to the number we expect it to be. So I think I'll stop at that, because beyond that I'll kind of step into proprietary stuff. But the key point I'm trying to highlight is, depending on what sort of custody you have, the process that we'll follow would be different.
And you have to verify the existence for every asset that the fund owns?
For the most part, there could be. It does not mean every single asset literally, but it would mean every material position that you have. Yes.
Okay. So that brings back in the materiality question that we talked about earlier.
It does.
If you deem it not material, you don't have to go through the verification of existence process.
There's nuance around that too, but depending on who you are as a client. So, for instance, the answer to that question could be slightly different if you're a registered investment advisor versus an emerging manager with a different kind of a regulatory situation. So, it's hard to have a black or white answer on that one.
Okay, so you verified the existence. You've kind of audited the valuation processes. What else is involved in the process, or is that the whole shebang?
I think for the investments, that's basically the key part of it. I think if you want to kind of go back to the audit part of it, I think the other I would mention two more things quickly just to add kind of more color to what the overall audit process is like. The other two pieces I think which are really important are, we do a pretty deep review of the allocation schedules. So making sure that the income and expense pieces that are allocated to the LPs are in line with the requirements of the LPA or other
Mm-hmm.
governing document, as the case may be. That is obviously a critical part, which is important both to the fund and to the stakeholders. And then the other piece of it is, making sure that we review the financial statements in detail, ensuring that requirements of the gap are being met, because our opinion sort of, states that the financial statements are prepared in accordance with gap. So we have to ensure that requirements of gap are being met sufficiently.
Got it. Okay. Sounds like fun.
It is.
So you read the LPAs that I write.
I actually do, and
Somebody reads them. Amazing.
I have a tremendous amount of respect for the allocation clause when it's written correctly. You have no idea how much joy it brings me.
Obviously, all of mine are written correctly. So,
of course,
I'm so glad to hear that. Okay, well, thank you for that high-level explanation. I recognize, as you mentioned, that there's a ton of nuance and wrinkles that go into each piece of this. So, I'm joking earlier, talking about how hard it is, but it really is an insanely time-consuming and intensive process. And so, I likewise have a lot of respect for what you all are able to do. And I have no means by which to judge if you're doing it correctly.
And I will add, before we move on to the next topic, I will add this. Everything I'm saying is primarily educational in nature. None of these are positions being taken by me or the firm. This is just a general overview of how we may think about certain things. So,
of course,
I had to throw the disclaimer in. I should have done that in the beginning.
You could be a lawyer yourself.
Well, too late for that, but it's okay.
It's never too late. Other sort of buzzwords I hear about when I think about auditors is auditor independence. Mm-hmm. So auditors, I understand, need to be independent. Can you tell me a little bit, like, what does that mean? Why do auditors need to be independent? Under what circumstances would they not be?
So in general, the concept of auditor independence refers to the independence of auditors from the client being audited. This includes financial interests, business relationships, and employment relationships. So as CPAs and as firms, we are required to comply with applicable independence rules, which could be the AICPA independence rules for funds managed by an exempt reporting advisor, or the SEC independence rules for funds managed by a registered investment advisor. There are many possibilities which can lead to independence being impaired, and we have robust systems in place to avoid those situations. A classic, easy to understand example would be an auditor trading the stocks of a public company client. You're not supposed to do that. So the easiest way to understand it is you don't want to create a situation where either your financial well-being or their financial well-being is dependent on you. That's the core of it.
Got it. And I assume there's a process you have to go through with new clients to make sure that nobody in the firm has specific conflicts related to that client.
Yeah, I wouldn't specifically speak to the systems we have in place, but as a general practice, every firm has some sort of process in place to ensure no such situation exists as they're proceeding with any kind of a client acceptance. The key is as you go through it, the rules that we're talking about at a very high level are extremely complex, and we have individuals who specialize in each set of these rules, and we spend a lot of time training and educating our people to ensure that we're maintaining our compliance with the applicable rules.
What information? I mean, this is a very high level question, so feel free to answer it similarly high level. What information do you need in order to do your work, in order to audit a fund? And I recognize it's going to change based on the nature of the assets they're investing in and things like that. But, high level, I know you have to read my LPAs. What else do you need?
Yeah, I think the best way to understand this is anything and everything which underlies the financial statements should be available and accessible. So, think about the financial statements, the underlying books and records, anything and everything in the GL system, and all of the supporting documents that you're using to support what you record in the GL system. So that sort of connects with what you were saying earlier. If you have a level 3 security, what you have in the GL system is probably just a fair value that you're recording. But what you have supporting that would be a model which wouldn't exist in the GL system, but we would need access to that. So
Mhm.
anything that is either appearing in the GL system or is supporting something that shows up in your financial statements, that should be available. Now, if again, the concept of materiality is obviously critical. We would not need every single thing, but it should be available if requested. That's the high level core of it. And then obviously if you were to pick any specific item on the financial statements, we can go pretty deep into, what do we need to get comfortable with that.
So I'm very tangentially involved. I mean, I'm not involved at all in the audit process beyond every single one of my fund clients that gets audited. I get a letter from their auditor every year saying, "Hey, give me some information about this fund. Has there been any litigation, or how much money did they owe you at the end of last year?" Things like that. Why is that information relevant to the audit process?
For a number of reasons, the simplest reason to discuss would be, to ensure that we know about any contingencies.
Okay.
So if there is, for instance, some sort of a regulatory process that you're helping them with, that could result in a significant uh, legal and financial risk, we need to be aware of that. Or if the client is being, threatened with litigation, or they're actively involved in litigation, that could result in a contingent liability, which we may need to record um, in line with GAAP. So that's the core reason for it. There could be other issues as well.
Okay. So I should continue replying to those letters then.
I would think so. That would be nice of you.
Okay,
It's
I'll do it.
and
Just for
the
you.
reason is usually it's one of the last things that are done, because we don't want to keep pinging the lawyers. You guys charge by the hour. It's not the most cost effective endeavor. So doing it timely really helps getting the audits done.
I think that makes sense. So, speaking of cost effectiveness, how do auditors charge? You don't have to give any secret sauce. You don't have to tell me what you charge, but big picture, is it like a flat rate? Is it hourly? I assume not, since you just besmirched my hourly compensation
I
mechanics.
kind of
But
I walked into that one, right? I could have avoided that.
walked right into it.
Um, but so most of our engagements tend to be fixed fee arrangements. To maintain our independence, we are not allowed to have any kind of contingent fee arrangements. That's just not allowed.
Mhm.
Um, but the fees in general are a function of the complexity and the volume of the fund's activities. So a fund with limited trading volumes and a liquid portfolio, the audit of that sort of a fund would be a lot less than a similarly sized fund with an illiquid strategy and a pretty complex portfolio. So on
Right.
on paper, you could look at two funds, like $100 million fund and another $100 million fund, but depending on what they do and what kind of investment strategy they're deploying, could result in a pretty significant difference on cost of an audit.
Yeah. I mean, I would imagine, just based on what we've talked about here today, right? If I have $100 million fund that's filled with level 1 assets, sounds like that's a lot easier for you than a level 3 fund, or a $100 million fund filled with level 3 assets. So you got to do a lot more work. Naturally, that would cost more.
And it is even more nuance around that. So it could be a level 1 fund, but let's say, for instance, you're a high frequency trader and you
Hmm.
have, 5,000 transactions per minute. You have an algorithm, some sort of a quant. Um, while that's all level 1, but just the trading volume creates a whole different set of challenges that you need to now get comfortable with. On the
Yep.
other hand, could be a level 3 fund, but you only have 3 positions,
Yep.
completely different set of challenges. So there's a lot of nuance around that answer, which it's hard to capture it in words, but we have to address it case by case.
Yeah. So if I'm an aspiring fund manager launching a new fund, and I'm going into a meeting with auditors, I should be prepared to tell them, about the nature of my trading strategy, how frequently am I trading, what are the assets I'm trading, because all of that information is going to be super relevant to you designing a quote.
I completely agree with that. Most fund managers are very good at defining, what the investment strategy is, because that's their specialty. So I usually don't see any issues there.
They're as good at that as you are at describing the audit process. Look at
There
that.
you go.
Okay, so I think I understand at a basic level how auditors charge for their services. So if I am that new fund manager, how should I think about how do I choose the right auditor? What should I think about there?
So I think specifically in the context of our industry, specialization matters a lot. I know
Hmm.
that's a pretty general statement. I think specialization matters in pretty much all industries. But the way I explain it to my prospects and clients is like it's really helpful to the client to work with an auditor who understands the complexities and the nuances of the fund and its investment strategy. I think we just talked about that. How you audit a digital asset fund is very different from how you audit a venture capital fund. So
Right.
working with industry experts saves a client a lot of time and effort in completing the audit. And we spend a lot of time hiring the best talent we can find and then training them on industry specific matters so clients will not need to spend any time explaining the business to them. That tends to be the biggest factor that I see where, if you have a team that is focused on, say, broadly alternative investments and understands the business, knows what an emerging manager is looking to do versus, what a more established firm is trying to do. And if you compare that to, say, the more, say, if I were to say this nicely, a more cost-effective option that you can find in the industry, but they don't really work in this industry, it it would it would over time cost you a lot more, and the process becomes a lot less efficient. I hope I that uh,
That was
came
very
across.
diplomatically said.
Yes. I was trying not to say anything which would be seen as not nice.
Yes, it was very nice. So thank you for that.
All right, cool.
So you've alluded to this over the course of this conversation so far, but we
Yeah.
talked about a little bit about how the auditor works with legal, right? You have to review the LPA. You need that letter from us when you're doing the audit. You talked a little bit about how, for a lot of funds, the fund administrator is the one providing a lot of the information, the backup information that you need to complete your audit. So it sounds like you work with at least those two service providers quite closely. Do you work closely with prime brokers also? Is there something you would change about my characterization of your relationships with the other fund service providers?
I think that this captures, I would say, the majority of it. So, we do work very closely with the service provider, specifically legal and fund admin, because quality of their work directly affects the quality and efficiency of an audit. So
Yep.
we spend a lot of time getting to know the fund admins and the law firms active in our space, and we ensure we understand their product in sufficient detail to deliver maximum value to our clients. An easy example of that would be, how an LPA is compiled by one firm. There is a specific way that reads, and understanding it well just delivers more value to our clients. So we ensure that we invest the time and get um, the maximum value that we can extract for our clients. So we do a lot of that. I think prime brokers, we do engage with more on the existence side of things, and then the other type of firms that somewhat are involved are the valuation firms, with some of our more established clients who use third party valuation firms. Understanding their valuation outputs and how they do their work also helps quite a bit. So we engage with them quite extensively as well.
Yeah. So I think that, I mean, I recognize this isn't your specific specialty, but if you're investing in a lot of level 3 assets that are super hard to value, maybe that manager is hiring a third party valuation firm that's helping them come up with the processes and methods to value these assets, and then when you come in to do your audit, you liaise with that
Yes.
third party valuation firm.
We do, and then we also have our in-house valuation experts that we bring in, so that way, we're bringing enough experience and expertise of valuation specific topics that we're able to, again, uh, do that more efficiently.
Yeah, that makes sense. And then, I actually didn't preview this question for you, so this is a surprise, so I apologize for that. But one question I think clients ask me a lot when I tell them that there is a requirement, a regulatory requirement for them to be audited, which is the case for some, but not all fund managers. Sometimes they ask, well, could I put off engaging the auditor? I'm going to launch my fund now. Let's say it's May, early May. I'm going to launch my fund. I don't need to get audited until the end of the year. So can I just wait to engage the auditor until the end of the year? What would you say to someone in that boat?
I would say engaging with the auditors early doesn't really cost anything per se. But
Hmm.
what it does add is more efficiency to the process in a few different ways. So one is, having a conversation early about what the audit requirement is, just helps you create a system that would help support the audits get done in a timely fashion. So
Yeah.
potentially, on the regulatory side, you could have, the custody rule requirement, or if you have an offshore presence, you may have a SEMA filing requirement that you may have to comply with. Both obviously have specific deadlines around them. The other one, which is more, contractual, is there might be an LPA requirement. There might be LPs who need those pieces of information in a timely fashion. So there are specific deadlines in that process. So having a process and a system in place and a dialogue in advance usually helps.
Yep.
You can always, do that later in the year. It just gives you less time to react to things and fix things as you were working through it.
That makes sense. If I engage an auditor at the beginning, they can tell me what they're going to need at come audit time, and then
Yeah.
I can prepare that information along the way rather than scrambling to prepare it last minute at the end of the year.
The
And
the the ideal scenario is that, we should probably, and this is what I recommend to most of my prospects, engage with us at a point in time when you are still working through the draft LPAs, so we can
y-
review the draft
yes.
and give you our input at that point. So anything that needs to be tweaked can be tweaked without, it becoming a problem down the line.
Yes, and that's what I tell my clients too is, if you're going to get this fund audited, engage the auditor now, have them review the LPA before we finalize it, because if they have comments, it'll be much easier to implement those comments now before you finalize than in
Yeah.
6 months, 8 months after you've onboarded 10 LPs, and then, you got to go
Yeah.
back and amend the LPA. So
Yeah. And
I'm
once,
on
yeah,
your page.
once you've had 3 calls, having to go back and redo the allocation schedule takes a lot of work.
Definitely. Definitely. My last question for you here is, putting on my new manager's shoes again, what is the smartest thing a new fund manager can do from the perspective of an auditor, in your opinion? Aside from investing fabulously and making tons of money.
Yeah, that I think that's always a good starting point. I think it the I would say as a key takeaway, in my opinion, the smartest thing would be to invest the time to fully understand the regulatory and financial reporting requirements of their funds. A standalone Delaware entity with onshore LPs is not the same from a regulatory perspective as a master feeder structure with Cayman registered funds. To help with the process, it would be wise to surround yourself with trusted experts who can answer your questions. Because, a lot of the fund managers, especially in the early days of their fund management life, most of them come from tremendous investing backgrounds, but getting a sense of what fund operations are all about, it takes a minute. So surrounding yourself with the right kind of experts, investing the time to go through what it takes, which involves both financial reporting, and also we didn't talk a lot about taxes on this one, but K1s are really important. Your LPs want those done in a timely fashion, which is a key part of it. So firms like mine have a lot of experts in the mix that would help you create those systems to ensure that your financial reporting is accurate and is timely. Those are critical concerns. So surrounding yourself with those folks at the earliest you can, even when you're probably not even close to the first close, is a good idea, because any
Hmm.
conversation you're having with us is adding value.
Great. So engage early.
Engage early and engage often.
There we go. Well, Salman, it's been a pleasure chatting fund audits with you. You have shared a tremendous amount of wisdom, and I really appreciate it.
Thank you. And as we were going through this conversation, I was starting to feel like we do add a lot of value. So
I think so too.
I appreciate you spotlighting us.
Anytime. It's the unheralded ones that need the most spotlighting. It's the lawyers and the auditors. Nobody likes us, but we do important work.
Well, we like each other. That's all that matters.
That's right. All right, Salman. Thank you.
All right. Awesome. Thanks, Dave. Thank you for having me.
Thanks for listening to Tokens of Wisdom with Dave Rothschild. I hope you enjoyed this episode. Please like, follow, and subscribe to our show wherever you get your podcasts. Well, now that all that boring stuff's out of the way, it's time for the part you've all been waiting for. The legal disclaimer. In this show, I describe laws and regulations from a 10,000-foot view. And while this should be obvious to most, I need to say it nonetheless. This show is for informational purposes only, and nothing I say here constitutes legal, investment, or tax advice. If you're thinking about starting a fund or you're curious about your options, this show is a good resource. But if you're going to pull the trigger and launch a fund, please engage an attorney to assist you.